Welcome to the Overview of Financial Statements module. In this module, we provide an overview of how financial statements relate to one another. But before we do that, let's briefly review some key concepts. Let's start with a simple definition of accounting. Accounting is the measuring, processing, and communicating of financial information. The measuring of financial information answers the what amount question. The processing of financial information occurs when we enter the information into our accounting records. The communicating of financial information involves summarizing the information and distributing it to appropriate users. Now, let's review how financial information is used in a business. Just like you would use your bank balance to make day-to-day decisions, the managers of a business use financial statements and supporting schedules for the same reason. Managers, or the internal users of accounting information, are the primary users of financial information. But they are not the only ones needing this information. External users, such as investors and creditors, use a business's financial information to make investing or loan decisions. There are also other external users who don't have a direct interest in the finances of a business, but do have a need to know. These users include the Internal Revenue Service, or IRS, and the Securities and Exchange Commission, or SEC. Okay, let's review our four primary financial statements. They are the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows. All financial statements start off with a title or header. The header starts with the name of the company. The second line of the header tells the reader which statement you are looking at. The third line defines the timing of the statement. The income statement, the statement of retained earnings, and the statement of cash flows show the user what happened within the business over a period of time. For example, for the year ended December 31st, 2015. Now, the timing of the balance sheet is unique. The balance sheet provides account balances as of a specific point in time. Because of this, the header of the balance sheet would include the name of the business, the name of the statement, and the specific date the statement was prepared. A good way to understand the difference in financial statement timing is to think about the income statement, the statement of retained earnings, and the statement of cash flows as movies, while the balance sheet is more of a photograph. Now, let's talk about the relationship of the financial statements to each other. When preparing statements, we start with the income statement. The income statement answers the question, how much do we make? The income statement is simply the total of the revenues or fees the business charged from the sale of its goods or services, minus the cost or expenses the business had to incur to generate that revenue. Next, as business owners, we want to know how our stake in the business has changed. This is shown on the statement of retained earnings. The statement of retained earnings is an illustration of what the owners had at the beginning of the period, plus any of their own money or assets they may have put into the business, less any money or assets they may have withdrawn for their own use, plus the net income for the period. Now note why we needed to prepare the income statement first. We need the net income number from the income statement in order to complete the statement of retained earnings. Next, we have the balance sheet. It informs the user of the current balances of each asset, liability, and equity account as of a specific date. It is nothing more than the financial statement representation of the accounting equation. We needed to prepare the statement of retained earnings before the balance sheet because the ending balance of retained earnings is needed to complete the equity section of the balance sheet. One final note about why it is called the balance sheet. Just like the accounting equation, the assets must equal or balance with the liabilities and equity. The final primary financial statement is the statement of cash flows. The statement is divided into three sections: operating activities, investing activities, and financing activities. A good way to think about the statement of cash flows is that it is a roadmap of cash going into and out of the business. It summarizes what happened in the cash account over the designated time period. Because of this, the final number in this statement, the ending balance of cash, should be the same as the cash balance found on the balance sheet. Okay, let's do a quick review. The different users of financial information include internal users, such as managers, and external users, such as investors, creditors, and regulatory agencies. The four financial statements include the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The income statement shows the user the revenues and expenses for the accounting period. The statement of retained earnings shows the user the adjustments to the retained earnings account during the year, including net income or losses and any dividends paid. The balance sheet shows the balances of assets, liabilities, and equity accounts as of a certain date. The statement of cash flows allows the user to determine how the cash flowed into and out of the business, whether it was through operations, investing, or financing activities. This completes this module. By now you should have a good understanding of the uses of financial statements, the mechanics of financial statements, and the relationship between the financial statements.